Tesla stock had a pretty good day today. It didn't end as well as it started. Tesla stock was approaching $220 per share, and we did not end that high. Now, here in this video, I will discuss what is coming next for Tesla stock, what's next for the markets that you need to know pretty urgently so you can prepare your portfolio for this. Now, if you're a long-term investor, nothing really changes here, but over the next coming months, there are things that you need to know that could potentially get you, I want to say, better prices on Tesla, better prices on our markets. Potentially in the next couple of months, we could actually see a vicious upside rally. And I will explain the balance of risk to reward in certain areas of our markets versus others. And trust me, you do not want to miss this. But first, let's start off with this interview from Tom Lee. If you know Tom Lee, he's been incredibly correct since the bottom in October of 2022. Yes, he was a little early calling for the pain in markets in 2022. It was going to be short-lived. That was obviously not true. But ever since that bottom, October of 2022, he has been not afraid to make short-term calls, short-term bets, and a lot of them, the vast majority of them, have come true, and he's became somewhat of a superstar of the investment world in recent years. Now, Tom Lee has about a 6-minute long interview today on CNBC where he discusses a lot of things that I agree with, okay? He thinks the lows are in for this year. Now, whether or not that happens comes down to the economic data. It comes down to whether or not recession odds do rise. So I don't know if I agree with that, but he thinks there's limited upside left in the S&P 500 throughout now until basically the election, okay? And I agree with that. We're about 2% off of all-time highs. We have seen a ferocious bounce back in markets. Now, Tom Lee believes the risk to reward, the highest potential reward versus the lowest risk, is actually in small caps, which makes a lot of sense from my perspective as well. He also believes small caps are in a multi-year bottoming process. Now, I agree with this sharply or concisely, because there's many areas of our economy that are already in a recession. As I pointed out in the last video, 3 out of every 5 Americans already believe we're in a recession. I would argue 95% of Americans don't know what a technical recession means, right? Two declining quarters of GDP growth in a row. I don't think a lot of people understand that, that's a technical definition of a recession. But there's a lot of pain out there. Now, as the Fed starts to cut rates, potentially those small cap areas, economically sensitive areas, like look at Tesla, look at Target, look at Dollar General, look at areas of the markets that are dependent on consumers spending money, they are in deep recessions, and those are going to be the areas that could actually do very well if we do avoid a recession. If the data starts to kind of come in good. Now, the areas that will not do well if we avoid a recession potentially could be big tech. We'll talk about that a little bit later throughout this video, but enjoy this clip from Tom Lee, where he gets a little bit more specific on what he sees next for markets.
Down the road ahead for stocks as we head into the sometimes tumultuous month of September, as Fundstrat Global Advisors co-founder, head of research Tom Lee joins us here at Post 9 on a summer Friday. Tom, thanks for coming in.
Great to see you.
Was it last week? Was it difficult to keep your bearings in the midst of that crazy price action?
Without question, because the market had been whipsawed by data point to data point, as you guys were recapping. You know, the jobs report raised recession fears, big risk off. Then we got inflation this week, which was pretty tame, and I think markets suddenly went back to thinking about liquidity coming into markets. I think that the data dependence of the markets and the Fed is very tough for investors. And I think if you look ahead, I'd say we always know the summer is tough. Summer probably runs through October, but I don't think that anything's changed into year end, which should look pretty good.
But are you lower conviction now than you were 2 weeks ago?
No change in our conviction, but it is just recognizing August historically is a tough month for markets. I mean, one thing that maybe investors can be encouraged by is since 1928, the most common month for the summer low is August, and the most common week is the first week of August. So I think maybe the worst is behind us, but it doesn't mean we're straight up from here.
Right, and I guess the question is, I keep going back to that moment in mid-July when we were at the highs. You were just shy of 5,700 on the S&P 500, and everything was a go. It was, the AI earnings path was kind of unquestioned. In addition to, general soft landing expectations, you kind of didn't have a lot of painful trade-offs to worry about in terms of policy or growth. Can we get back to something like that? I guess the idea, as you say, maybe summer lasts through October. Do you expect that we're going to have to continue to reset around these levels?
Yeah, I think if my best guess would be, it's still going to be a struggle, but we're climbing the escalator again. I think Jackson Hole is going to set a positive tone on balance, just because the evidence is growing. FOMC members want to be forward-looking, as you guys are pointing out. Data dependence is dangerous at turning points, and then we get the jobs report for August, which I think should reverse some of things that could be temporary. I mean, that's a guess, and if it is, then recession risk is sort of reduced. But now we have real rates are too high, and that means investors will be comfortable with cutting.
I'm thinking back to some of the notes you wrote after the last jobs number, and you looked at Hurricane Beryl and the number of companies in Texas that had no power for 2 weeks, and you do think August will be reassuring on the NFP print?
Yes. I mean, in some ways, the weekly claims is telling the story. We had a surge in claims, multi-month high, that have come down since then. And so even if someone says there was no effect from the hurricane, how do you explain claims really improving so much, especially in places like Texas? And, a million homes without power for 2 weeks, how could that not affect the local economy and the jobs market?
This rebound that we've gotten from the lows of early last week, initially, certainly until yesterday, it was back to the first half winners. It was a lot of the mega cap growth stocks, and the equal weight S&P really didn't have that much of a pullback, and it's closer to its highs. But small caps definitely got a flush, and yesterday they rallied big on that retail sales number. But it seems like that's still been a complicated attempt at a rotation.
That's right. They always say bottoms are tough, and bottoms are a process, and small caps are really in the process of what we think is a multi-year bottom. And so conviction is not going to be as strong as things that have been working. I think most people's toolkit is to buy the triple Q, the NASDAQ or the AI names when they want to get back in the markets. But cutting rates at a time when small caps trade at 10 times forward PE, better earnings growth, and then a visible path to easing, I would say it still makes sense that the risk reward is in small caps.
And then, we had a miss on housing starts this morning. So it's funny, the parts of the economy you thought you could rely on for a while, maybe are giving way as other ones maybe start to bottom. But what's your thought there in terms of the flow through to the rest of the economy?
I think housing, auto sales, and durable goods are essentially in recession. Mm-hmm. It makes sense because cost of money is so high. I mean, it's super expensive and hard to afford a home or to buy a car with these rates. These are also directly benefiting from Fed cuts because adjustable rate mortgages adjust, business loans adjust, auto loans, credit card, they're sensitive to short-term
builders'
rates.
loans too. I mean, if you're building
that's
a house.
Right. Cost of money for builders, yeah. And so I think these really benefit from an easing cycle, but a market that believes there's an easing cycle underway.
How many cuts you think we get this year?
I'm looking at consensus, which is somewhere between 4 and 5.
Before the end of the year?
Yes.
So about 100 basis points?
I think that's right, but it depends on where inflation prints the next couple months. But our base case is that we're on a glide path towards 2%. That's better than consensus. So I think 4 to 5 still makes sense.
And you've been, part of your thesis has been that elements of CPI have been falling, in your words, like a rock.
Yes.
I actually saw that phrase repeated in another desk note yesterday, so that's spreading. But are you as assured of that? And when you look at things like car insurance or some of the coincident costs of owning a vehicle, as you point out?
Yeah, I think one of the things that surprises us still is that two things are keeping inflation high on a weighted basis. Shelter and auto insurance. Auto insurance adequacy is there now. If you look at the results from these auto insurers, they don't need to raise rates, so I think that's cooling, and that'll come in the second half. And for housing, rent is stabilizing, and I think housing is going to cool. It just needs to get to 3 to 4%, and then markets will be comfortable that we're back at 2. But median inflation rate is still 1%. That's below Fed's.
Yeah. Well, I think as Greg Ip said this week, rents are inertial. It takes time for those new rents to cycle in.
Yeah, that's right.
So let me know your thoughts on that clip from Tom Lee down below in the comment section. As I previously said, I pretty much agree with the vast majority of what he's saying. Now, I don't know if the lows are in. Eventually, there will be a recession. Eventually, we will fall maybe 50% from here. I mean, that just depends on the economic data. And I do struggle with 55, 60% of Americans believing we're already in a recession. Economic conditions from the University of Michigan survey out today that shows the worst current economic conditions by Americans since December of 2022. I mean, last time you were at these levels, markets were down almost 30% from all-time highs, right? I don't understand how you could have a consumer, an American, that feels so shitty about the economy, and that does not translate into economic pain, okay? Sure, I guess theoretically anything's possible, but as the consumer, as the average American feels worse and worse about our economy, they're likely spending less money. They're likely having a harder time getting a raise. They're likely having a harder time finding a better paying job or just finding a job in general. Again, spending less money, cutting back where they need to. I think eventually this does translate into an economy that does weaken. The balance here is, recession and no recession or soft landing. It's kind of a fine line, and it can go quickly. The deterioration into a recession normally happens just within a couple of months. So do we see that deterioration on a rapid scale? I don't know. The Fed also has a lot of room to start accommodating our markets, but initial signs are that real estate's just doing worse. Right? We did have building permits today and housing starts that came out this morning, much, much worse than expected. In fact, the construction employment sector of our markets is seeing a little bit more fear today based on the data that we got with new construction starts that are starting to fall quite a bit. That's even as 10-year Treasury yields have went from, let's call it 5% down to 3.8%, 3.9% in recent days. That initial fall, that we've seen in Treasury yields and borrowing costs, because borrowing costs are more so fixed to the 10-year Treasury yield than the Fed funds rate, you're not seeing that really spurring economic activity yet. Whether or not stocks do well from here, generally speaking, I think comes down to one, the Fed, September 18th, but also, more importantly, the economic data. Now, the markets are currently pricing in about 77% chance of a 25 basis point cut. I think a 25 basis point cut will be seen as favorable and bullish by the markets. A 50 basis point cut will be seen as bad news by the markets. Simply put, investors always say, hey, if the Fed is able to cut methodically and systematically, and they're not forced to cut because the economy is, rapidly weakening, that has to be good, right? That's good news. If the Fed is forced to cut by large margins, that suggests the Fed is too late, there's too much economic pain already, and the Fed is rapidly trying to accommodate the markets. Now, historically, when the Fed starts to cut rates, stocks, the SPY, tend to fall about 23% over the course of about 100 days, 90, 100 days or so. About 3 months, you tend to see a pretty significant down move in markets. And that's still possible. Bank of America says you should sell the first Fed rate cut. But I really think it comes down to 25 or 50 basis points. If we get 25 basis points, then that's a sign the economy is at least doing okay, right? And the Fed will take a little bit of a, foot off the neck of the economy and the markets. But if they have to cut more, that's probably not going to be seen as good news. Now, thinking about this logically, okay, there are companies that benefit from the Fed raising rates. There are companies that do not benefit from the Fed raising rates. Besides big tech, nobody really benefits from the Fed raising rates, okay? But big tech, coincidentally, this cycle is about 40% of the S&P. We're talking about your Super 6 stocks, your Googles, Amazons, Microsofts, Apples. These companies have anywhere from $50 to $200 billion of cash in the bank. They are taking in, massive interest on, their cash yielding 5%. What if you have $100 billion of cash in the bank? That's $5 billion net bottom line profits for nothing every year, as Fed fund rates are 5%, as you can get 5% in a money market fund. At the same time, the Fed raising rates doesn't hurt Microsoft, it doesn't hurt Google, it doesn't hurt Apple, right? These are not financed products. These are products that are usually enterprise to enterprise more than they are tied to the consumer, okay? So really long story short, big tech has benefited from the Fed raising rates. Big tech has also benefited from being, quote, perceived recession resilient. So investors have been willing to pay a higher multiple for Apple, Google, Microsoft, and these other big tech names, than they historically do or have in the past, even with less growth today than other periods in time. That's because this perceived recession resilience. We all know there is no recession resilience with big tech. We've seen that in 2022. Big tech got destroyed, okay? But that's the market's perspective right now. So what will happen if we actually do see the economy heading towards a soft landing, the Fed able to methodically, strategically cut rates, not panic cut rates, but just maybe 25 basis points at every meeting for the next year or two. That would be methodical, systematically cutting rates. Then I could make the argument that big tech may actually fall in price. Big tech's multiple may actually fall as this recession does not materialize. With big tech being 40% of the index, on the way up, it feels great if you're in big tech or in the S&P because Super 6 benefits from the Fed raising rates. On the way down, not so much. Okay, think about it like this. If simple math's sake here, big tech, a lot of these stocks are up 100+% since the pre-COVID peaks, right? Some more, some a little bit less. If you consider 40% of the S&P roughly is these Super 6 stocks, and they're up 100%, that's 80% of essentially the gain we've seen in the S&P 500 based on 6 companies. The rest of the markets really don't need to do anything. And you get a market that goes higher based on these 6 stocks. Now, NVIDIA has definitely supercharged that quite a bit. That's fair. And I think NVIDIA is really a different story. Semiconductors, the path of that, could be benefited from rates falling. I guess we'll have to see. Long story short, I would expect Tom Lee is correct. Small caps, consumer cyclicals, interest rate sensitive companies that heavily invest will be the ones to benefit most. And that is Tesla. Tesla fits that definition. All the criteria is met by Tesla. It's also met by companies that are dependent on the consumer doing well. And apparently the consumer is not doing well right now. Okay. So I think vast areas of our markets can actually start to perform very well as the Fed does start to cut rates, as long as there's not a panic and recession fears at the same time. Whereas big tech, the S&P as a headline, may not do all too well. And that's basically what Tom Lee said in that clip. Now, in the short term, like over the next week, we really don't have anything as far as market moving events. On Monday, you have Fed Waller that speaks, some 3-6 month bond auctions, literally like nothing important. Tuesday, you have Fed Bostic, Fed Bar that speak. Nothing important. On Wednesday, you do have the FOMC minutes. Markets don't tend to react too much based on that, so I don't think that's too important. Thursday, you have initial jobless claims, continuing jobless claims, S&P Global Composite PMIs, Chicago Fed National Activity Index, new home sales, existing home sales, Kansas Fed data. Thursday's the day in which you get some data, but it's really going to come down to initial jobless claims. Those are expected to fall again for the 3rd straight week in a row, down to 225,000. As you are kind of lowering expectations that initial jobless claims are going to continue to fall, you do have a chance that they could pop back up again, and that could be a negative catalyst for Thursday. But beyond just that, there's not much. Now, Friday, August 23rd, you do have Fed Jerome Powell speaking at Jackson Hole Economic Symposium, and that is going to be a big catalyst for our markets, but it's not until the end of the week that we have any remote catalyst for next week. And really from Jackson Hole, again, it's going to be important 25 basis points or 50 basis points. 50 basis points signals more of a panic to start cutting rates. 25 basis points signals more of this, the economy's fine. We just got to start getting back to somewhat neutral, not as restrictive, because inflation has fallen so much. So I think Thursday and Friday of next week, those are going to be the catalyst days. I mean, at this point, you've rallied so much, you're probably going to see a stair step down motion at some point early to mid next week, likely before Thursday or Thursday, in anticipation of Powell on Friday. I don't think there is much upside left for the S&P 500 at this point, okay? There's just not a catalyst. With the economy weakening, the Fed about to start cutting rates, which is historically negative, with Q3, Q4 earnings comps that are going to be a lot tougher to beat over the next 2 quarters. What's the catalyst at this point? China looks like it's going to shit. Okay, let's just say that. I don't really see an upside catalyst for the broader S&P. Really big tech. Now, you also have NVIDIA earnings, not this upcoming week, but next week. We're expecting something good, but is that already priced into NVIDIA? NVIDIA has been, rocketing higher from $90 almost back to new all-time highs again. Like, that's probably priced into NVIDIA now at this point. That could actually be a negative catalyst for NVIDIA earnings, because you're again pricing in really good news at this point. So from the perspective of the broader markets, which you can really categorize as big tech, Super 6, that's what dominates the S&P as a headline. I don't see much upside left for those stocks. But if the soft landing narrative does start to prevail, if the Fed does not spark panic next week, Tesla, consumer cyclicals, interest rate sensitive stocks that are trading at lower valuations that they've really traded at over the last 5, 10 plus years, those are the areas that can start to do very well. And I think Tesla is specific in nature because they invest a lot. They're heavily dependent on interest rates, heavily dependent on the consumer doing well, heavily dependent on the economy, again, staying out of a recession. If that is what starts to materialize from here, I could see broader upside for Tesla compared to the markets. Now, we do have election risk, geopolitical risk, and I do think we're going to fall from here before we're just going to rip higher, okay? I think the balance of risk to reward is much more skewed towards a downside move before an upside move. Each and every piece of economic data will be heavily scrutinized by the markets. And I do think with Tesla's event coming October 10th is really just bad timing. That's going to put us right in the thick of it, if you will, for some of your election uncertainty. That's going to be after the Fed cuts rates, either 25 or 50 basis points. Historically, that's not usually a good period for markets. Perhaps the economy could weaken a little bit further between now and October 10th. You can make the argument that that's just a bad time for such an important event like this, but I still am under the assumption heading into that event, Tesla stock's either going to rally into it, sell off after, or sell off into it and rally after. I think that's probably the easiest way to play this. I do like Tesla a lot at current prices because, again, if there's, let's call it a 40% odds of a softish landing, the Fed's starting to cut rates, the consumer actually getting better from here, Tesla stock could easily double next year. Maybe go to $600 per share. I think the AI optimism will shift from semiconductors to companies that are actually applying applicable real world AI, which there's no other company like Tesla doing that today. There's just not, okay? Solving the biggest problem in the world, which is full self-driving, like Tesla. Back in 2017, Tim Cook, Apple's CEO, said solving fully self-driving vehicles is the mother of all AI projects. That was long before the markets cared about AI to the same extent as it does today. That was back in 2017. And I think you'll be heavily rewarded for your patience in Tesla, and especially as rates start to fall. I think that's going to be a pretty big tailwind for Tesla stock. And we'll know more coming this upcoming Friday. And that's why I felt the need to make this video, because I think the Fed's going to give us 25 basis points. I think the markets are going to like that. Not big tech, so don't expect much from the S&P, but you could see a broader internal market rally as long as initial jobless claims do not come in higher than expected, as long as the economy continues to chug along. So I really think it's a balance of risks right now. If you're not in Tesla, if you're not in stocks, I think you want to be in stocks, not super sick stocks necessarily, my opinion, not financial advice, but the areas that will benefit from lower rates and a consumer that could potentially get better. I also think it's far too soon to tell whether we are actually heading into a recession or not. And thus, I think you want to keep a lot of cash on the sidelines as well. So let me know what you think about this information down below in the comments section. This is a fine line of balancing risks to potential rewards. And if you want to take risks, I think it makes a lot more sense in small caps, consumer cyclicals, value stocks even, compared to, call it super six. I think Tesla offers a much better risk to reward than Apple or Microsoft or Google or even Amazon for that matter. So you guys enjoy the rest of your day, and I will see you in the next one.